In this lesson, we will learn about advanced practices and reporting of tax due diligence. The topics for this lesson are as follows. 1. Transactional tax planning. 2. TDD methodologies by area. 3. Cross-border tax considerations. 4. Structuring for tax efficiency in cross-border deals. 5. Writing a TDD report. Transactional tax planning involves strategizing for tax implications arising from transactions, utilizing tax losses, and ensuring efficient tax outcomes. This guide provides a structured approach tailored for those new to M&A to navigate the complexities of transactional tax planning. Understanding transaction-related tax planning. Anticipating post-acquisition tax negotiations. Focus on preparing for discussions with tax authorities after the deal. Consider potential areas of dispute and develop strategies to address them effectively. Resolving outstanding tax issues. Determine who will handle and resolve tax issues post-acquisition. It's crucial to decide whether the buyer or seller will take responsibility for these issues, as it can significantly affect the deal's financial outcome. Pre-acquisition activities implications. Be mindful of how activities such as share structure reorganization before the acquisition can lead to tax liabilities post-transaction. This requires careful analysis of the target company's past actions and their potential tax consequences. Strategizing for post-acquisition tax issues. Evaluating tax losses. Assess how a change in ownership affects the utilization of the target's unused trading losses and other tax attributes. This involves a thorough examination of the target's past financials and projecting how these tax losses can be used strategically post-acquisition. Handling unusual tax situations. Prepare for scenarios where pre-acquisition activities may result in unexpected tax liabilities. This includes evaluating the tax implications of past reorganizations or share capital adjustments. Utilizing tax losses. Leveraging tax losses in deal structure. Integrate tax losses into the deal structure to optimize tax savings. This can involve structuring the acquisition to utilize the target's existing tax losses, thereby reducing the overall tax liability of the combined entity. Ownership change impact. Analyze the implications of ownership changes on tax losses. Different jurisdictions have varying rules regarding the carry-forward of tax losses post-acquisition, making it essential to consider these aspects in the deal structure. Effective transactional tax planning is critical in M&A, focusing on preempting tax negotiations, resolving existing tax issues, and strategically leveraging tax losses.